Hello and welcome to the Power Real Estate Investing Show. We have an amazing guest today, Fred Hubler. Fred is an accomplished entrepreneur with over 20 years of experience in the financial services industry. Over 20 years ago, he founded Creative Capital Wealth Management Group, which is a nationally recognized wealth management firm. Creative Capital has been providing clients access to vetted, accredited investments for over 20 years in over 30 states. Fred, welcome to the show. We're thrilled to have you.
Thank you. Thank you for having me. Great to be here.
Awesome. Why don't we start with you sharing with the audience a little bit more about you beyond what I just said?
Oh, sure. So, I was a stockbroker for a firm you would know of that's in everyone's town. My first day was 9/11, so I had to drive to go
My
get my
God.
license and drive the training. And I spent 2 years there until I realized it was just sales. It wasn't advising, it wasn't consulting, it was no planning. And what did it for me was I came into the office and there's a list of people to call, and the stock of the day was Merck. And my dad was on that list. And I had every dollar my dad ever had. To this day, I don't know anyone that's ever worked harder than my dad. And he should have had more for the amount of work that he did. But you know, a lot of people work really hard, but don't really find the thing that makes them have that leverage. So I was naive enough, and I have an MBA. I know all about this stuff, but I was naive enough to call the investment, the investment council that prints this out. I'm like, hey, how do you know this is right for these people? Merck's the stock of the day. I'm like, yeah, but how do you know these people need Merck? Like, they have cash in their account. So that was the beginning of me saying, you know what, this isn't for me. So after 2 years, started up my own company, and I went from being told what to sell and frankly who to sell it to having no one telling me anything. And now I'm looking around saying, oh, now what do I do? So as a hardworking but smart and a little bit lazy MBA, I don't want to reinvent the wheel. I studied where people with wealth put their money, and at the time, and still to this day, Harvard and Yale Foundation comes up as almost the poster child for where their wealth is. About 70-80% of their money is not in stock market. It's in real estate. It's in things your listeners are already knowing. That's the way wealth is made. And so I focused on where they are versus the stocks, and that was 20 years ago. So we've been doing alternative investments. My zip code was Valley Forge, which is the same area that Vanguard's in. And I knew, again, I'm not naive. I'm never going to be bigger, never going to be cheaper. How do I compete in Chester County, or even any, and now we're in 34 states, but how do I compete locally when everyone thinks mutual funds are free? I decided to take the path less traveled. And 20 years later, I look like a genius. I honestly just did it to look different. And I did it because I thought it was the right thing to do, but I had no frame of reference that it was. And now all the glory is 20 years a little bit late. Now I don't need the glory. Now I know it works. I have 20 years of helping clients. So that's basically the story. We're alternatives, not because it's different, just because it's different. We're alternatives because I thought it was better. And I use the people that have a ton of money as a reference point of where they put it. And as I see more and more big clients that come in and work with us, most of their money is in real estate, most of the money in private equity, even if it's their own business, their own private business. Very few people say, hey, I'm a multimillionaire because I picked the right stocks. And then in the world out there, the answer is, well, what about Warren Buffett? He does private equity in a public market. Like, he buys the company, he puts people on the board. He lends money, and so it's not the same as, he doesn't buy the stock and just holds it. He buys into the company and becomes big enough in the company to do something about it.
Right.
And Berkshire Hathaway is filled with private companies. Now, Berkshire
Yeah.
Hathaway is a public company, but inside, it's not, so it's fun to see the real world versus what we're told. And then once you know what to look for, you can see beyond the the facade of how people tell you things are working versus how they really work. So we're alternatives. We still do regular management. There's a place for stocks and bonds in a portfolio. We're not shying away from it. Definitely not interested in putting more money into it today.
Right.
Unless there's some hedges or covered calls or some way to protect the downside, because we really believe that the downside is more likely than the upside. And last election cycle, we had a pandemic, so my bingo card, I don't know what's going to be marked off, but it's going to be an interesting time, and I hope it's not going to be a bad, interesting time.
Agreed, agreed. Well, that was a lot, Fred. So let's unpack a little bit about what you shared about you. So your first day of your what was going to be corporate career was 9/11.
Yep.
literally that day. Do you think that was a pivotal moment? Do you think that impacted the trajectory of your path in
So
general?
what it did for me is my license for the Series 7, the New York stockbroker license, had to wait a week to even be, because it was off for, the market was closed for a week. So once we were licensed, once we could call the clients that we had, talked to before, just very ancillarily, I again called the people behind the scenes. And I grew up with the X-Files, so I trust nobody. I grew up with Ronald Reagan, so trust but verify. And when I called the American Funds people, which are a great fund company, their answer was, hey, I said, what do I do now? Really, I was calling around saying, okay, what do we do now? The buildings are literally still smoking. What do we do now? And whoever I called, the answer was their product. Now, again, I'm not stupid, but I'm not, I'm not an idiot. It seemed very self-serving. So the American funds guy said, well, you buy more American funds. The stock guy, they said, oh, you download, you should, create a portfolio of individual stocks. And then the
Sure.
bond guy also said it was the best time to get in. I'm like, stocks and bonds don't, you both can't be right.
Right.
And then I even called the annuity people, and of course, their answer was best time to buy an annuity. So I very quickly realized, and that's why I didn't stay more than 2 years. I really hoped it was different. I didn't know, I was naive. I came from corporate America before I came into doing financial services. I was the guy that bought stock at 13, 14 with my mom's E-Trade account. I would help my friends buy stock, and I would do their taxes, and they would change the oil in my car. So that's the relationship we had, and they're all still friends of mine. And they don't have to do my oil anymore, and I don't have to do their taxes anymore. So that created the thing in me to look beyond traditional investing, because I knew they couldn't all be right.
Of course.
And then I realized how much of the industry is a sales industry, and with a straight face, the value proposition is find someone you like and trust. They charge you 1%. They put your money in harm's way with stocks and bonds, and then they give you the advice. To me, I felt that there's a better way of doing it. And so 5 years ago, I went to retainerbasedplanning.com. Nobody even owned it. I bought it for 99 cents from, I think, GoDaddy. Now I own it. Then I also have a trademarked version of retainer-based planning, and that allows us to work with clients, and they don't have to buy anything from us. They never have to buy anything from us. They just hire us and we charge a quarterly retainer for advice on anything, anywhere. So how do they keep their key person? How do they buy out their partner? How do they leverage this real estate? Like, all that stuff comes to us. The neatest one was, how do I buy a jet? And the fun part is, if it's a question we've never been answered before, we got 9 people here, we figure it out. But now we know the answer for the next person that says they want to buy a jet. Well, I know how you can deduct 100% when you buy it. We know the aviation CPA that focuses on all the rules around owning a jet and all the tax benefits. And then
Yeah.
we also found and vetted a really good charter service. So for this individual client, he went from paying NetJets to making money, because when he's not using it, it's going to get chartered out. And he wrote off $7 million off his taxable income.
Amazing.
So fun
Excellent.
stuff like that gets us out of bed. That's the fun part.
Yeah, got it. Fred, I love how you said that you were calling different investment professionals that had their own specialties, whether it's stocks, bonds, and so forth, and they were all recommending the products. Immediately, what came to mind, what if physicians did the same thing? We went to a gastro or an orthopedic surgeon, and they would start recommending the services. That sounded quite scary. So with investing, I guess it's less scary because it doesn't impact your body overall, but still definitely not a fun experience. And kudos to you for recognizing that trend. And obviously you have a lot of integrity, and you've incorporated into your services and what you do for your clients. So it sounds like what Creative Capital has become today, and I'm sure it was evolving over time, is a variety of services. And it sounds like you offer both Wall Street and Main Street services. So let's unpack that. Please share with our listeners what kind of services your company offers, and then we may go into individuals.
So we broke it down into 2 paths. One is agnostic advice. And so that's the retainer. It typically is on the table for people that have so much going on, they don't know what's going on. The net worth typically not investable, not money to give us. They don't, that side, they don't have to give us anything. It tends to make sense around 3 million and above. So it's not for everybody, but it's for people that have a lot of moving parts and don't want to go to a trust company and give them $10 million just to get advice. Again, that advice is kind of pivoted to buy more stocks and bonds. So in that world, the retainer is about $12,000 on the small end and charge quarterly. So it has to make sense for them. But in the advice side of our house, any sentence with a $sign and a question mark comes to us. Doesn't have to be invalid. How do I buy my next car? How do I lease? I want to buy out my partner. Like, we get it all. And that's the retainer part. If you have a lawyer on retainer, we're just wealth strategists on retainer. And they get a wealth strategist, which is our version of a financial advisor. I don't think we give advice. I think we give strategies, because advice tends to say, here's the thing I sell that you should buy. Strategies should be bigger than that. So we always, even if we don't want it to be, even if we don't think it's the best answer, we tend to give clients 3 options. And I make sure, as long as it's possible, that one of the options doesn't point back to us. One of the options is not us, just so you can trust that we're not just looking for things to do. So in that world, that's one of the reasons we grew so fast. And are in 34 states, is clients engage us for the advice. The money's never moving. So we're not asking you to trust us with your money. The money stays where it's at. You tell us where it is. We do the analysis. We tell you what to tell your Morgan Stanley guys. So it's very clean. But in that world, they're probably accredited, which, as you probably know, it's $1 million not counting your house. And then that lets us use what we do on the other side. So there's advice on one side, and then there's access. The second thing we do is provide access to regulated FINRA, SEC, we're registered fiduciaries, products that are on the shelf, not just for me. They're not my products. No one's doing anything for me special, because I don't want that. But they're there, but not many people know they exist. Not many broker dealers, because that's the channel they're deployed to the public, even sign up for it, because some of them are illiquid. Some of them have blown up before. Again, we don't use, we do all of our vetting, but if it's on the shelf, doesn't mean we sell it. If it's on the shelf, it means we can look at it. But I've been in it long enough that I get calls from people saying, hey, before we register this product, what would you need it to do for your clients? And or they'll say, this is a really good product. It's 60 million is as much as it's going to raise. Well, Vanguard probably just made that why I told you the story. So it definitely is a different scale. And so we have a legal and ethical and moral unfair advantage that we see deals that other people don't even know and by the time they find out, it's already filled, probably by me, or someone like me or someone else did the 60 million and took it off. And it's that second part, that access, that's where we can do non-stocks and bonds for people. That's where we do a lot of real estate things that benefit real estate, which I'd love to talk to you. We'll talk about that. But dumbing it down, for me, not for you, dumbing it down, we do access and we do advice. Everything else is a subset of that. And everything is client facing and for the client. So we won't do anything unless it benefits our client. I now look like one of my clients. This is my family office. 9 out of 10 things we show a client, I'm already in, because I liked it myself. I wanted it myself. I'm doing the real estate myself. And I have an advisor in our office that's my advisor, because I'm too busy growing it to also, and I want checks and balances. And my wife now works with us, so she wants to have someone to talk to that's not her husband. So I'm in my own family office, but I want to stay happily married. I think I joked with you before about this. If I retire, I would probably show my wife how to load the dishwasher the right way, and you would never find my body. So I want to be live. I want to be happily married. And I love what I'm doing. It was hard for so long that I keep looking over my shoulder for how easy it is. We're getting deals, individual deals, the size of my book of business 10 years ago. And our monthly revenue used to be an annual revenue years ago. So it's starting to really, everyone talks about the hockey stick. It sounds great until you're riding the plane that pulls up really fast. It's a little scary. You get that butterfly in your stomach, and I have great people around me. I keep hiring. We have 3 more people we just brought on. So we're built for it. The strange thing is the recognition we're getting outside of the office. Been in the Wall Street Journal 4 times, never paid for it. It's not an ad.
Amazing.
And I don't know any other advisor that's been in the Wall Street Journal that wasn't going to jail. Like every other I've ever read about where, Bernie Madoff or someone that did something illegal, they were positive, non-jail related, interviews about us. And a lot of it had to do with the retainer. It's a simple idea. No one knew it's an option, but when they do, like, I want that. I want someone to look at my stuff. And the retainer is as long as it adds value to the client. So it's not an ongoing thing, that $12,000, and most people don't pay that because as soon as we move it to maintenance mode. And so the bill, what we paid in a quarter is now what you pay for the year. So we have never lost anybody because of our costs. If anything, we're cheaper because now we can advise on stuff outside of us that you otherwise would be paying 1% on. Well, we can put that at Vanguard in your name. It's not with us, in your name, and we'll still tell you where to go with it. My joke is I'm one of the few roles in the world that I can, politely ask a woman her age without being slapped, and I can tell anyone where to stick it because that's what we're supposed to do. Like that's our job.
Incredible. Love it about you, Fred. Thank you for sharing that. So I like how you're in your own investments and you do what you preach. Essentially, it speaks volume about you. And to your earlier comment about you're not the vanguards of the world and don't want to be, never say never, because at the pace that you're growing, you might be the vanguard of the world tomorrow or the day after tomorrow. You never know. You guys are growing. What you do is not offered widely, and there are not that many companies that do what you do. In fact, I don't know anyone else besides Creative Capital that has such big variety of offerings both on Main Street and Wall Street altogether. So let's go back to the family office because I think some of our listeners might be interested to hearing more about family office. Why don't you start with a little bit of a definition of what family office is, and if someone is kind of on the border deciding, do I need a family office or not, how would they decide? What kind of path did you take in deciding that you needed a family office for your own family?
Great question. So a family office can be a bunch of things. If you're a Rockefeller and you're worth $100 million, a family office basically vets your nanny and does your travel and does everything about you because you're worth 100 million bucks. You don't do anything. That tends to be you hiring an entire firm and they just work for the Ford family, the Rockefellers, and they're already out there. And again, they're closed down. And then that now we're not trying to even compete with that. What we say as a family office is an advisory built firm that can give advice for a client no matter where the assets are and can be the first place the question gets asked, and we'll have meetings about you without you. Like we goes beyond a financial advisor and goes beyond investments. So I would say if a client has a lot of moving parts and a good example, so we have 3 profiles we really focus on, and we have a trademarked, you can't trademark retainer-based planning just like you can't trademark vanilla ice cream. So we call it milestone clarification process, MCP, and there's a lot on our website about it. We have one for working professionals. So let's say that person is a C-level at a corporation, $7 million in their 401k, but really nothing else because they're still working. They're worth 7 million bucks. They don't know what to do in their 401k because they're probably really busy because they're a C-level. They probably have kids to go through college. They have life insurance needs. They don't have someone to work with who isn't a salesperson. And if they do have 100,000 that they save to go give to a guy, that guy or girl can't give them $7 million of advice on $100,000. Like there's a mismatch there.
Yep.
So the retainer basically says, we'll charge you quarterly to do everything for you. So when you get for the professional, when you get your executive comp options, the document they write it on is confusing, let alone the thing you're trying to decide. Like it gets really, really hairy.
Yep.
We have multiple CPAs in our CFP, certified financial planners, in our office. Everyone's on salary. No one's on commission. No one has a production requirement because I don't want them to feel hungry and I don't want my clients to feel like they're being pushed. So I pay them really well, which is a risk on my end, but it's a risk that I think pays off for it has paid off.
Agreed.
So professionals, they would want a family office to just deal with the stuff they don't know what to do with. And they may be getting some answers from their CPA, but probably not the right answers because the CPA only can take it so far. Legally, the CPA can't give them advice on how to manage your 401k. And that's not fair to them. Like they should have better options. If you are a business owner, which is the second profile that we have and when I say profile, it's not just who we want to go after. We have built workflows, we have built the process, we have built the path per each profile because they're
Yep.
similar in some cases and they're different in other cases. An executive working for someone else has none of the levers that you and I do if we're business owners. So they can't buy a Tesla and write it off. Like, they just can't do it. But they can do a lot of things. They can super fund life insurance outside of the 401k, like the whole bunch of stuff. Or they can put cash into a DST to build up real estate that they don't have to manage, but it's real estate. Like, there's some fun stuff they can do. Business owners have a lot of, they now have the employees. So how do you keep your key employee? That's the second profile. And the third one, only because I can do it in my sleep, is high net worth retirees. Those people with 7 million in their IRA after they do roll over from the 401k and they're all in stocks and bonds or even mutual funds, they deserve better. Mutual funds were meant for people that didn't have money to get a nice diversified portfolio. Seeing someone literally with $17 million in mutual funds, it is very unprofessional for them to have done that to themselves, because that's not what the mutual fund wasn't meant for. The millionaire it was meant for the person that didn't have enough money to have more than one stock, and that's really risky. So put
Yep.
that $100 in a fund that now has 300 stocks in it. And the first time, and I'll share with you a little bit my personality, and also, I think it's a good story. We had a gentleman come over and say, here's, can you analyze my portfolio? We had 4 other advisors, happened to be $17 million of money, and we have software that analyzes the holdings. And there's only about 3,400 tickers in the stock market, and there's really only about 1,200 that people own in a mutual fund. There's only so many Teslas and Procter, Philip Morris, and American Express, like all the big companies we know,
Yep.
IBM. There's only so many of them. So this gentleman had $17 million with 4 different advisors. I wasn't one of them. And it just so happened, based on the analytics, if you brought all of it together and consolidated it, he matched exactly the S&P 500, the amount that was telecommunications, the amount that was healthcare. Like, it was scary how much it was perfect to the S&P 500. So we
Okay.
do our analysis, and then a couple days later, a couple weeks later, we have our meeting. Like, here, I'm going to save you a ton of money. You don't need an advisor, including me. And this is the part that I should not have enjoyed this as much as I did, but I think you know me enough to know that you know my sense of humor. I
Yep.
told him, you don't have to do anything with me or any of the other 4 advisors. Fire everybody. Put it all into SPY. What do you mean? It's like, you are matching identical to this S&P 500, so just buy the index. It's low cost. You don't have to, all your statements, it's all in one. And he sat there, isn't it stupid to have all my money in one ticker? And this is the part I still get a giggle out of, Frank, a professional giggle. I said, yes, and you already did. And then I just let the pregnant pause sit there. And I'm like, all right, he's not going to fire me because he hasn't hired me yet, so I'm not losing the revenue. And at that level, people worth millions of dollars, no one talks to them that way. And I don't want to bully anybody. I'm trying to be authentic and show them how it really is. Because at that level, and you probably see it yourself, people, if you have a lot of money, people like you because you have a lot of money, or they're families of you and they don't want to, mess up the gravy train. Or they're employed by you, so they don't mess up their job. So that, great idea, even if it stinks. That's why I need to go outside of my office, talk to people like you today, here's what we're doing. So after the pregnant pause, the guy, and this is why he has $17 million, he said, how do I fix it? So his ego, he realized, he thought he was diversified. He wasn't. He realized that he didn't realize, and no one really does, that they're all fishing. And so the analogy I want to leave everyone the analogy I want to leave everyone I ever talk to is, we have the vision that it's a gigantic ocean, lots of boats out there. It is a 4-inch deep lake, the stock market is, and all those boats are flat bottom. And the people with real money aren't in the market. They are in real estate. They are in private equity. They are in small turnaround deals. There's a ton of places. So the smartest kids in the class aren't at the beach.
Right.
They're somewhere else. And that's who we follow. And the thing that I think I didn't realize the value of is what we're calling in our office, the flywheel concept. And a perfect example, one of our clients owns multiple franchises, multiple restaurants of the same franchise. And I asked him, hey, if you have 18 and I want to open up number 1, do I have a chance? He's like, of course not. And it made sense. And so what we really look for, and there's a Forbes article And my only ask of your listeners, it's free. If you go to Forbes.com and put in my last name, you'll get my articles for free. And the reason I ask is I have a 12-year-old daughter that has a YouTube channel that has more subscribers than my Forbes. And I should be competitive with my 12-year-old daughter. I love her, but I'm competitive. And she lets me know, hey, Dad, I have more subscribers than you. And it's not the same. I mean, she's playing with slime and I'm talking about DSTs and alternative investments. But one of the things I just did that isn't out yet is how we look for these alternative investments. And it's very similar. It's legal, ethical, moral, unfair advantages. I'm not trying to break the rules. I'm not trying to hurt anybody, but and so when I had this conversation with the franchise owner, I realized that's a legal and ethical and moral unfair advantage. If you can get in and you're in, or you can get successful, the franchise companies are the kingmakers. And I thought but I never thought about it. Like, so then I get off literally his plane. He had a plane. And I'm like, how do I make money for my clients? Because if I make enough money for my clients, and I found a focused private equity firm that all they do is buy within a region 3 of the franchise that used to be a Yum brand. So the back end is the same operating system.
Right.
And they only buy it from retiring baby boomers who haven't updated the restaurant. And if you update a Taco Bell or any of these franchises, if you update them, sales go up because it's a nice, clean, fresh store, new branding, all that other good stuff. It's the same taco, or it's the same chicken, or it's the same hamburger. Like, it's the same thing. And so this company does that, and I realized, and it's a registered product. So we do the due diligence. We now offer to our clients. And the reason, and this is the flywheel concept, the reason I even thought about, hey, how do I get access to that, is having a conversation with a client. And when the retainer clients, they show us everything. And I may see something you do that I never saw before that works for you. And I'm not taking anything away from you. Like, again, it didn't impact him. If anything, he likes the new idea because he's not allowed to own directly any other franchise, but he can own an investment that has other franchises. So very diversification. And I thanked him for him. Like, hey, if it wasn't for our conversation on your plane, I never would have thought that, the kingmakers, how do I get involved with that? And how can my clients make money with that? So that flywheel concept of looking at where clients are, making sure they're not doing anything stupid, and then seeing, oh my God, what is that? How do I do that? That starts to that makes it our product. We get better because of our clients, and we can see what they're doing. Because a lot of them, I would say most of them are rich before they got here, and we're really finding out it's maybe 3 or 4 or 5 different ways. Everyone's doing it the same way. They either find a niche in real estate that they get good at, they can find and flip, or they can fix and flip, or they're buying the long-term hold, or they buy businesses and turn them around. Like, whatever it is, a lot of times about 80% overlap, and a lot of them are aggregation. You buy little things until they're big, and then you sell to someone who has a check to write the big things because they didn't want to have the time to buy the little things.
Right.
And that works in real estate, that works in business, that works in commodities. Like there's oil and gas. Like we have a ton of the same special play in completely different industries because it works. And I tell all of our clients and I tell my staff, we can't explain an investment on a white cocktail napkin that you get at a wedding. We don't do it. So anything that has derivatives, anything that takes that cocktail napkin to like fold out, they're the things that go wrong fast first when things don't perfectly aligned to what the pro forma was. 100% of the time. Like, I've never seen any complicated investment not do good, not do really bad because somehow the algorithm didn't was too complicated to include everything. The simpler the idea, the more likely as long as it's a good idea, the more likely it works.
Excellent. So on that note, have you had any investments that you recommended or offered to your clients that have gone bad or lost
Yeah.
client capital?
So there's 2 right now which really bother me. One was a private preferred stock of a public company that owns farmland. How safe can that be? It's owning farmland, and the kind of farmland we're talking about are there's a recurring crop, pistachios, almonds. What happens there is obviously you harvest the pistachios, but you don't take the plants away. The plants stay there.
Yeah.
So they just come every year. So they're recurring crops. And the company investors get into it privately. And then after 5 years, they get 6, 7%, like it was meant to be a safe, out of the market. And then it becomes a public preferred stock. So it's preferred stock. Preferred stock's supposed to trade at $25 par value. Like, that's just math. And there was the first one that we did it, and it went to the market, and it's at the $25. Clients didn't lose any money. They made their income and then they get out, and we can do something else with it. So same company, same strategy, second version of it. What I didn't realize was that second version has a different ticker, obviously, and I knew that, and no one's looking at it. So when that second version went public, there's not enough market to bring the value up. It should financially, it should be the exact same price as the first one. They are identical things, but the market isn't smart. And I never realized how stupid the market is. And I don't mean that in a bad way. It just doesn't make sense. So that's one example. The other one is a very good investment of multifamily. That's, $300 million, but because of the Fed interest rates and cap rate compression, it's down 25%. Haven't lost. The properties are great. The tenants haven't missed a bill. Multifamily, as you know, is strong in a demographic standpoint because people can't afford a house. And so that's painful when you know it's wrong, but if it's not right if the world doesn't see it right. And so there are things in the market where people think the market's up. No, seven of the stocks of the S&P 500 made the whole thing go up. It's only the seven. Everything else kind of crappy. So we have decided that any of our new strategies won't have a public exit because I don't trust the public. And I just can't trust the public. So those things, again, I'm still bullish on the multifamily. For the smarter clients, they're adding more money because now it's a 25% discount to get the same thing they bought at full price. But it's painful to see something down that, shouldn't be, and it shouldn't be just because of what it is. But none of us expected the Fed to be as fast and as furious, no pun intended, as they were. And multifamily doesn't have a Zillow comp. They have to say, okay, what's the cap rate? People will invest this based on the income. And if interest rates are higher, we got to account for that. So then the value has to be adjusted to make sure it's still competitive. And frankly, the frustrating thing is none of these properties are for sale. So we're marking it down to a market that isn't really what we're trying to do, but the laws require it. And as an aside, treasury bonds, which we haven't got into because, but the banks don't have to mark to market like you and I do. So most of the banks out there bought bonds when they were 2%, and now bonds are higher, and their $1 million bonds are on the street worth 600,000 in an example, but on their books show it as $1 million, but it's not worth $1 million. So they have the opposite issue of me. I have things that are worth 25% less that really aren't, but we have to, and they get to, sometimes I wish I was a bank, but I couldn't do half the stuff I could as a bank.
Makes sense. Frank, going back to the multifamily operator you mentioned, did they not buy the rate cap and they're going at a floating rate now? Is that why they losing?
No, they have fixed debt on the properties. It's just when you value the property, you have to account for the market. And when less people have more expensive money to buy your building, you have to account for that in the current valuation of your building. But I have no doubt the building is going to, there's tenants are there, and some of these, and it's a nationwide program, so we weren't just betting on one place. Like we're very conservative in our underwriting. We don't know who's going to be hot, so let's do a little bit everywhere. So we didn't bet on one thing. And some of the actual underlying properties have a wait list for the apartments because they're new, they're nice, and they're fairly valued. No one's trying to gouge anybody. Renting to people in middle America is, middle income, working class people. That's where, they need the place. They have the money, they have a job. No one's buying McMansions anymore, and no one's, trying to build new penthouse lofts anywhere because there's no demand for that. And if you have it, you probably have it at a 2, 3, 4% mortgage. Why would you get another one that's 6, 7, 8? So there's a real, there's still damage yet to be seen from the increase in interest rates. So there's a lot of cracks in the dam, and I think we just want to be very conservative. And I tell all of our clients, build up cash, and build up dry capital, either for opportunities or to cover the bills if things that you thought were going to work didn't work as advertised.
So with this operator, it doesn't sound like they're necessarily losing money, losing investment. All they need to do is, since they have a fixed rate loan, they need to ride this wave essentially and wait until the market turns so they can sell it
Yep.
at a more profitable time.
And
So it's not a lost investment.
no, not at all. And here's the funny thing, 10, 15 years ago, the law allowed operators like that not to value their properties until they were ready to sell.
Yeah,
This same investment 15 years ago, the statements would have been the same. Now, the clients would have known they probably wouldn't get full price of the apartment if they had to sell it right now with interest rates as high, but the clients weren't in any pain.
right,
And that to me, it was a good intention. The government wants transparency, but sometimes transparency, if your house went down in value on Zillow, just because, but it's not for sale, you have no intent in moving, are you going to change it on your balance sheet? Are you going to change it on your own one? You're probably not going to.
right.
But the law, because people complained about, hey, it's not really worth that. I want to know what's really worth. Okay, well, this is the side effect of that is now we have to mark it down, even though you're not getting out of it, even though they're not selling it, even though nothing's changed. It's actually making more money because the value went down, so the dividend rate went up. And that's a frustrating thing because it wasn't like the investment didn't work, and it wasn't like the investment worked, the thesis worked. The world is different now. So we have to kind of, not that I ever want to hide a client's value, but the law allowed the value not to have to be a mark to market for no reason, especially if it's not liquid. Now they do. So this, what do they say? The road to hell is paved with good intention. That's one of those are two things in real time for real reasons, but the underlying investment, it's a good investment. Like there's some bad investments. The underlying investments, like you said, they didn't do a rate cap, or they had variable interest rates at 2%, never knowing interest rates could go up. Of course they can.
Yeah,
This isn't any of that. Those things should go down in value. Those things should be off the market, and people that invest in those things should lose money. I mean, capitalism should have some, commandments that need to be followed. So it's a problem we have to deal with, but we don't put any significant money. We don't ever put clients in any amount that would hurt them. And all of our clients are long term, and they're like, oh, how about when we show them like, well, can I add more? And the smart ones say, can I add more money?
right.
And then we try to suggest for the ones that we're taking money out, we take money from somewhere else and you reinvest the dividends back into the thing that's down, so you can start to make up for that. But we're probably a year or two away from that coming full circle, or at least coming back. And it's painful. But I think most of our clients, we educate them. And the interesting thing is they know, because the math's there, that we weren't wrong. It's just things didn't, the government stepped in and didn't really help us in this situation.
Yeah.
Which when do they come, right? Why don't help me? I'm with the government. I'm here to help you. That's like the worst things to hear.
Agreed. Fred, you've added a ton of value to our listeners. We definitely appreciate that. Two final questions that we always ask our listeners. Number one is, how do you like to give back?
So I run a food pantry that has fed 300,000 meals since COVID.
Wow.
It wasn't mine. It was already there, but I was asked to be on the board, and next thing I know, I'm becoming president. I had to change some leadership. And then we had to, I'm not a very tall person, and our food basement was like a fruit cellar, and I hit my head. I found out today, because we raised, and it was called, we had COVID grants, all that. We have a new building. The square footage of just our freezers and refrigerators is bigger than the entire building we sold in 2020. So
Incredible.
we 10x'd it, like at the 2,400 square feet to 24,000 square feet. So that's my giving back. I've been doing it for 7 years. I'm the chairman of the board. The bylaws say you only can have 7 years, and I'm done. Like at the end of the day, I'm done. So I give back there. We have a family foundation. Our office, we give back at the office level. Today, it's not giving back, but it's giving back to my team. Today, after a all hands meeting, we're going to go through axes as a team. And I got my wife found a lot of embarrassing photos. Like if you're talking and they take a photo of you, your mouth is open, but it shouldn't be. I'm in the press a lot and I talk a lot, and every picture of me in the newspaper, I look like there's something wrong with me because my mouth is open. Well, she has those photos, and we're going to put that on the axe targets. And so I don't know if it's good or bad, but you can't
It's
have
good.
fun. What's the point?
It's
So
good. Fred, it's
my
good
team's
publicity.
yeah, my team's going to be throwing axes at me at 12 o'clock today.
Yeah, no, that's awesome.
Hopefully
Yeah,
the picture of me, not me, but the picture of me.
right. Hopefully the picture. Yeah, we want you to stay alive. And with your sense of humor, it's definitely can hurt you, but it can help you at the same time. But I really do appreciate your dry sense of humor. And the last question we ask our people that we interview is, how can our audience reach out to you, where they can find you?
Our website, so it's CCWMG, Cat William Mary Greg, stands for Creative Capital Wealth Manager Group. It is being relaunched, so it's out there, and then there's a new one probably in a month. So I spent a lot of money on the new one, and I definitely want, so keep checking. So that's two things, ccwmg.com. And then from an educational standpoint, I was hired by Forbes to write about alternative investments in a way that anyone can understand it. So if you go to Forbes.com, the Forbes, and put in my last name, HUB as in boy, LER, you'll get all my articles. It is free. And that you can read that and kind of get an idea. When we say alternative investments, no one knows what that means. I'm in 20 years. It always means something different when you're talking to somebody. There are strategies behind every article. I am not talking product, just like we didn't do today. I'm not here to sell. I'm here to serve.
Right.
So that is another way I give back. I don't want to be the weird alternative investment guy that you've never heard of what I'm doing or how I'm doing it. So the more I can tell people and let them educate themselves, and then they can go Google other things, the better it is for everybody. Because I think I really feel in my head I'm lifting up the velvet rope and letting people that I care about on the first class part, because there's options there that they qualify for. And we even have private equity options for people that aren't accredited. They just have to have 70,000 of income or 70,000 in net worth, which should be a lot of people. And,
Right.
it's
For
true
sure.
private equity. It's registered in FINRA and SEC, and it's all real. But it can never be advertised. It's not like I can get mail a flyer out to people. So at Forbes.com and ccwmg.com, that you'll have a lot of information there. You can contact us. You can have an SOS free review of your stuff. And I think we have a YouTube channel. You can see the commercials. I made fun of Fisher Investments. Probably shouldn't have. I made fun of politics on both sides. I'm fairly, on both sides. I also jump in the shower with a guy in a third commercial, and it's all about alternative investments. So it's a little cheeky. There's a fourth one coming out in the Philly area in April, and I'm not in it this one. And we just talk about the risk in your portfolio. We have software we invested in that will look at someone's stock and bond portfolio, and based on proxy of history or individual history of that investment or that ticker, we can show clients the best 6 months or the worst 6 months of their portfolio. So I'm happy to do that for your listeners. It takes us maybe 15 minutes. I mean, I would like to say it's a big, heavy lift, but it really isn't. We hired more people. I just poached a few more people from Vanguard. So we have the staff to do it. And that's an easy give for, again, giving back. They don't do any business with us. We do need to know what they're invested in so we can put it in the computer. But
Right.
it's just a portfolio review, and we would give them the results. They can go to their own Edward Jones guy or Merrill Lynch guy. We're not, they don't have to use us to fix it, but it's like giving an x-ray on your portfolio. And it's nice to know the worst 6 months and the best 6 months of your stuff before it happens. Because if it's a range you're comfortable with, don't do anything. If it's a range that gives you heart palpitations, address it. And you and your listeners are smart enough to know what that means. It might mean lowering risk or lowering some, or increasing some exposure to something you don't already have, or increasing cash in the portfolio. Some of the levers are pretty simple.
Of course, of course. Fred, again, this has been phenomenal. I could probably interview you for 3 more hours, but we'll probably do part
I
two.
can come back if you ever, have a spot that you
Absolutely.
need some more. I'm happy to come back. Obviously, I can talk, and you're a great interviewee or
For a little
interviewer,
while.
and hopefully I'm a good interviewee.
Yes, yeah, no, very much enjoyed it. Thank you so much, Fred.
Thank you very much. Thanks for having me.